Welcome to Atlanta's Commercial Real Estate Show, brought to you by Bull Realty, the show for property owners and business leaders. Host Michael Bull brings you market analysis, advice, and opportunities around Atlanta.
Hello, welcome to Atlanta's Commercial Real Estate Show. I'm Michael Bull, and this segment is brought to you by my company, Bull Realty Asset and Occupancy Solutions. Visit bullrealty.com. Today we're going to talk about single-tenant net lease investment properties. Please welcome my guests. I have Fred Weir here. He's president with Meadowbrook Restaurant Co, and Nancy Miller. She's president with the National Net Lease Investment Group at Bull Realty. Thanks for being with us here.
Thank you.
Glad to be here. So, single-tenant net lease properties, it seems like that a lot of investors, when they're buying these kinds of properties, they're really looking at the tenant, they're looking at the industry, and they're not as concerned about locations. But everybody's heard the adage, right, when it comes to real estate, location, location, location. So what's the difference in value to you guys of a property that's maybe in Metro Atlanta compared to something that's more rural or in a much smaller market?
The construction costs are pretty much a wash wherever you are, but obviously the cost of land or the dirt is going to be far higher in Atlanta, which is going to be reflected on a much higher purchase price. I could, for example, buy a Dollar General in a Metro Atlanta suburb for now approaching $2 million. That same Dollar General in another market like a Waycross or a Valdosta or somewhere even smaller might be $1.1 to $1.3 million.
How about the cap rate difference, or is it the same?
The cap rates might be, it's a great question. The cap rates are going to be somewhat similar. They're going to be lower in the major metro like Atlanta or Athens or Columbus, and they're going to be higher in the tertiary markets, and especially we call them podunk markets, which they could be, for example, in Atlanta it might be a 6 cap, and in podunk it might be a 6.4, 6.5.
Podunk.
Podunk. I could say something else, but I won't.
East Bumblechuck?
Yes, something like that.
What do you see, Fred?
We see the same thing, and obviously the question for us kind of on the operator side is that sometimes density can be as much of a problem because you have a location where you have a tremendous amount of people, but you, especially in Atlanta, everyone knows about the traffic, and you have a location where...
Don't talk about the traffic.
No. Yeah. I was going to say you want to do a separate show on all the other corporate headquarters coming in adding to it, but you become a victim of your own, I say a victim of just the density around there because no one wants to get out. You have a location, it's like, oh, the traffic counts are just off the chart and triple they are anywhere else, which may be the truth, but then you also have a problem when traffic's constantly moving at 5 miles an hour. People don't want to get out of that to have to get back in. And we have seen that in certain things where not necessarily where you want to go to East Bumblechuck or Podunkville, but sometimes a site that you're sometimes better off in a site where there's not as much density, where the access is a lot easier. The other thing that we have to watch out for with density too is how is that density split up on day parts. For us, there are a lot of great city locations where you would tear it up at lunch, but then everyone is going elsewhere for dinner. And the nature for any QSR user now is you really have to have 2 solid day parts, whether that's breakfast and lunch or lunch and dinner, or in the case of some like Atlanta Bread, Nukes, things like that, where you have a real solid lunch and a super solid catering delivery type program. But the reality is you've got to have 2 solid day parts, and there has to be a real understanding when we're looking at real estate is, are those day parts going to be there? And then can your guest really get to and from you?
Are there hot markets around Atlanta for investors that want to be in for these types of properties, or for you guys as operators?
I think there are hot markets. I think that we're so infilled already, it's challenging, and I think from what I'm seeing, the growth actually is in the outlying areas, your Dawsonvilles, your Snellvilles, all your villes, if you will. rather than in your inner city. I think prices.
Doraville, but not Podunkville.
That's right, Doraville,
Okay.
Podunkville, Fairbornville, those kinds of places where you have a little bit more land available, and you still have a density of population, retail or whatever population that will use it. So I'm seeing an expansion to secondary areas outside the perimeter and so
Yeah.
forth. Inside, it's just too darn expensive.
You know, it used to be you'd see retailers kind of banking on that development coming. Do you guys do that anymore? Or is it no? I need to see the houses there. You know, you.
A little bit of both.
Okay.
You know, certainly I think because of the last real estate bust, there's still kind of a question in the back of everyone's mind is saying just because you see a bunch of lots cleared and they're going to put 1,000 home subdivision, you know, there's still the question is really, you know, is it all 1,000 homes going to be built and built in a reasonable amount of time that it'll affect us? Certainly, I think that's still a question guys are asking.
And are you guys looking for sites around Metro Atlanta now, or?
We are. We're constantly looking. I think you have to be unless you're just content with not growing. But certainly there was a huge feeding frenzy. We had a lot of new players coming in that were just paying insane amounts, and I think a lot of those people are suddenly realizing that the prices they were paying, their AUVs are pretty much the same as their industry was doing everywhere else, and that just because a property seemed really hot or there's a lot of synergy, that it didn't necessarily correlate to much higher sales. And I don't know that there's been a complete drawback, but I certainly know just in talking with other guys and even with our own thing, people are far more conscious of their thresholds and maybe not stepping over those.
And you're looking for sites for Zaxby's and who else?
Also, we've gotten in with Dairy Queen as well, and so we're looking for sites for both Zaxby's
What's a
and Dairy
perfect
Queen now.
site for one of those, or both?
I think it really varies. On the Dairy Queen side, you know, the takeout is not is great just because of the nature of the product. You know, certainly Zaxby's chicken tenders, it's realistic to carry those home and eat them 30 minutes later, and it's still a great meal. Obviously, the nature of ice cream, especially in summer in the South, you're almost instant consumption, whether it's in drive-through or not, just because of the reality of the product. And I think, too, ice cream is more of a choice than necessarily when people make the choice to go and get a Blizzard. They've already decided they're going to get a Blizzard. Sometimes we may be a little bit more of an impulse buy. But on the Zaxby side, we're actually looking at because a lot more of our business is drive-through, and I think over time a lot more of our business is going to be through alternative delivery, whether it's Uber Eats or something along those lines. We're not necessarily looking for the 1.2 to 1.4 acres to put a 90-seat store. We're looking for a significantly smaller store there that's going to focus on convenience, access, drive-through.
So you might be able to do with less than an acre?
Yes, and we're certainly, as a brand, having that conversation. And it's not just us. I think a lot of brands, when you look at a lot of the stores that are being built now, their focus is more on drive-through. The building is more narrow. It's more streamlined. And their focus is different than it was even 10 years ago.
You were looking for out parcels? You want to be around other restaurants?
I think a little bit of both. You know, there's certainly some value to us if we can kind of get to something before it really happens, and certainly because of the reputation that Zaxby's has, there's also some value in us kind of sometimes being that milking cow for a developer that wants to do something, and we may be the first out parcel. And so we've been able to go to them and say, hey, look, you know, you've got a quality operator that you're going to be able to have bragging rights with. But certainly there's some value to that, and in some cases we've been able to get a better price on what we're going to do. So,
well, you know, at Dairy Queen you have those dilly bars, which are great. Do you still have those?
We still have those. Matter of fact, we've got a freezer home stocked with them because that's the number one request when I'm on my way home.
Well, they must be popular now because of the saying "dilly dilly," you know. So
yeah, it requires you to have two bars in each hand.
Can I come back to a little bit of this infill question?
Yes, please.
I just observed something. There's a new development in Brookhaven towards the Chambly line. It's a Whole Foods anchored center. It's got an out parcel of a Starbucks and one of these taqueria, something Del Sol, and so forth. It has a bunch of people that would, businesses that would normally be standalone, but most of them are in line. It broke the record. It just sold for $65 million, and it was amazing. It was a record breaker, and I think that in town, what we're seeing is people who would be standalone are now deciding to go in line. So that's how they get in town. In a lot of cases where you have a lot of high density, and you'll have the traffic generators of the Whole Foods and of the Starbucks and so forth. And if you're driving down the road in your car and you're hearing this on the radio, you're not a real estate person. Standalone's your freestanding buildings, and inline is in a shopping center or a mall or something like that, usually a strip center or shopping center. Well, that's interesting. So what's the future of single tenant net lease of these kinds of properties around Atlanta? Is there still room to add a lot more of these? Are we getting too many restaurants in Atlanta? Seems like there's a lot of choices.
I think there's certainly a lot of choices, and there'll probably be some ones that don't make it. Again, I think the ones that will, and the ones that'll have a lasting relationship, understand that to be successful, it's not about how great your food tastes. It's not about just getting the best location. It's about having a relationship with your guest and honoring that trust factor with them. And the brands and the operators who do, regardless of whether they're serving burgers, chicken, ice cream, whatever, the ones that do, they'll last long term.
Dilly, yeah.
And converse to food, what we're seeing a lot of infill and standalone and inline, we're seeing some small 2 to 3 tenant triple net lease properties developing in Atlanta Metro. Like you'll have a Sherwin-Williams because there's so much density of housing there, or you'll have them next to maybe a Subway, which is a good filler. So you do have some different combinations that will fill a 2 or 3 tenant strip center that will be able to be built an 10,000 square foot strip on an acre and a half. So,
and Nancy, if you track cap rates on these single tenant net lease properties around the country in the Southeast and around Atlanta, how does Atlanta fare compared to some of these other markets?
Atlanta's cap rates are very strong. Georgia is actually, I was looking at in the Southeast, Florida and Georgia have done the dominant number of transactions in the Southeast. They represent about over 50% of the transaction activity in the Southeast. Atlanta and some of the larger metros are where that's all coming from. And cap rate wise, the average in Georgia is about a 6.34 cap rate overall in Georgia.
Yeah, and that's a sample properties of what, $1.5 million to $5 million?
Yeah, this is a sample from CoStar, and they're all single tenant net leased, all types of properties that are single tenant properties.
And what would you expect cap rates? Let me get to the commercial real estate show crystal ball out for you, Nancy.
Oh, sure. Okay.
Because I know you get asked this by sellers and buyers. Today, there'll probably 10 people ask you this. What would you expect the cap rate on my 12-year single tenant net lease Zaxby's or Dollar Store to be if it's in Metro Atlanta today compared to, say, a year from now? Especially if what they're saying is interest rates are going to rise a quarter of a point every time the Fed meets. Obviously, the cost of funds is going to go up. So what would be your crystal ball into a cap rate change a year from now?
Well, if
I'm
a dollar store with a long 15-year lease, I have no rent increase for that 15 years, so it's flat. So what I bought into it today at a 6 or a 6.5 cap, that's what I have throughout the term. But if I bought one of these Zaxby's over here, I'm probably going to have a rent increase every 5 years, and it might be 5 to 7 to maybe 10% increase. So if I'm looking at yield, no matter what, I'm going to do better with my Zaxby's, assuming my interest rate is the same and it doesn't balloon and do crazy things. I'm going to want to go with that.
Right. So the flat lease makes sense. If you have a flat lease like a drugstore or something, you don't have any rent increases. that's going to impact the higher interest rates on the funding, on the financing. It's obviously going to
Sure.
hurt the value more than the ones that will increase. But just let's go to the one to say it's a Zaxby's and it has an increase every 5 years. If there's a 100 basis point increase in the financing, and I'm financed, and most of these are what 50 to 65% financed, and what 80% of them are financed. So how might that impact cap rates in a year?
Well, if cap rates will go up, regardless across the board, the Dollar General developers will be less greedy because they have to be. And
But they're not greedy. You mean they'll be
I think they're opportunistic. Okay.
Hungry.
hungry? They're
No, they're not
motivated.
hungry at all.
Motivated.
They have plenty. They're not hungry. But I think you're going to see the cap rates rise across the board, and it depends again on the holding time. If I have a lot of lease term left, no matter what, my cap rate is going to be lower because I have a lot of term left
Sure.
than it would be if.
Well, let's go specific. I want you to look at crystal ball again.
Okay.
I'm talking to you, May. I want to think about selling my building.
All right.
And if interest rates are going to be 100 basis points higher in a year, and I don't have any rent increase in the next year, how might my cap rate change on my single tenant net lease property? Half.
It will go up slower. It won't be 100 basis points up. It'll go up slower. It follows, but it'll go up a good 50 basis points for sure.
Okay.
For sure.
Well, we've done some analysis on 50 basis points cap rate changes on some of the properties, and it can be significant. We did one the other day, and the 50 basis points cap rate difference was $3.5 million.
Wow.
So, I think that can be significant as you're trying to time what to do.
Sure.
Well, any closing tips for our Atlanta audience on this?
Yes, call me anytime and I'll answer any questions
All
that
right.
you have.
Ask Nancy.
That's
Fred,
right.
any closing tips for maybe operators or developers around Atlanta?
I think there's still great opportunity out there. For the guys that are really kind of focused on the service end of it. Certainly, that's been for us at Zaxby's. I think really why we've continued to be successful. You'll see continued great success.
Yeah. All right. Excellent. Well, thanks for joining us.
Thank you.
And thank you for joining us on Atlanta's Commercial Real Estate Show.